Imagine you're holding a stock in your portfolio, and you get the quarterly earnings report.
Always a stressful day.
Right. And you read that they just grew their hottest, most in-demand tech product by like 20% in a single quarter.
Which is massive.
It's huge. You read that they partnered with the creators of one of the world's absolute smartest artificial intelligence models.
Yeah.
You see that they somehow expanded their profit margins in the middle of just a brutal, unforgiving macroeconomic environment. You'd think they'd be popping champagne on the earnings call, right?
You'd expect the stock to just soar.
Exactly. But instead, management gets on the microphone and tells Wall Street to, lower its expectations for the rest of the year. Why?
It's the ultimate contradiction, I mean.
That makes no sense.
Right. You have this company that's currently executing flawlessly on the technological front, proving their value in real time, but simultaneously they're staring into this thick, impenetrable fog when they look out at the next 6 to 9 months.
Welcome to a special, highly actionable Talk Tickers edition of The Deep Dive. Our mission today is to break down the Q1 2026 earnings call for EPAM Systems, ticker symbol EPAM, strictly for you, the retail investor.
The folks actually putting their own money on the line.
Exactly. If you hold EPAM, if you're looking at the IT services sector, or if you're just trying to figure out who is actually making money on the AI boom instead of just, talking about it, this is for you.
And we have some ground rules for how we tackle these earnings calls. First off, we are heavily data forward.
Right.
We're going to look at the exact numbers management reported, not just the press release spin. Second, we're translating all dense Wall Street and Silicon Valley jargon into just plain English.
Because, if a company can't explain what they do simply, it usually means they're hiding something.
Oh, absolutely.
You want to know the mechanisms, the actual how and why behind the business, not just the what.
Precisely. Third, we are going to take a firm position. We're going to tell you what we think this actually means for the underlying health of the business.
And finally, we want you to walk away with an actionable bottom line.
A real takeaway.
Yeah. So let's jump right into the paradox. If you look at the Q1 numbers just in a vacuum, it feels like a massive win.
It really does.
Total revenue hit $1.4 billion. That's a 7.6% year-over-year growth. Though I know there's a caveat there with how global companies report money.
Yeah, there is. Because when you strip out currency fluctuations, what analysts call organic constant currency growth, the actual underlying business only grew by 3.7%.
Which, doesn't sound massive.
No, it doesn't.
But for you listening, keep in mind that $1.4 billion figure hit the absolute high end of management's own outlook range.
Right. They promised a certain performance and they hit the very ceiling of it.
And the bottom line, the actual profitability, looked even healthier. Let's look at earnings per share, or EPS.
Always a big one.
Yeah. On a GAAP basis, which is, the strictest, most rigid accounting standard required by regulators, EPS came in at $1.52. That's up almost 19% year over year.
But Wall Street usually prefers non-GAAP, right?
Right.
Because it strips out things like stock-based compensation and one-time restructuring costs to give you a clearer picture of the actual day-to-day operating performance.
That's correct. And on that non-GAAP basis, EPAM's EPS was a robust $2.86.
Wow.
Also up almost 19%. But the metric that really tells the story of this quarter is the margins.
Okay, let's hear them.
GAAP gross margins improved to 27.7%, up from 26.9% last year, and non-GAAP gross margins hit 29.4%.
Okay, stop right there. I have to push back on this because if you're holding this stock, you should be deeply skeptical of margin expansion right now.
Why is that?
Well, think about it like a runner setting a personal best in the first leg of a relay race. It looks stellar on paper. But if a company only grows its organic revenue by 3.7%, yet their profits jump by 19%.
That's a huge gap.
It is. It usually means they're bleeding the company dry to make the quarter look good. Are they actually selling more valuable products, or are they just firing thousands of developers to make the spreadsheets look pretty for the analysts?
It's a completely valid suspicion. When revenue growth is sluggish but margins spike, your instinct should always be to look for the hatchet.
Exactly. Where are the cuts?
But if we dig into the transcript, the chief financial officer, Jason Peterson, he outlined a strategy that's actually a blend of both offense and defense.
Okay, let's start with the offense, because raising prices in 2026 just sounds impossible.
It does.
Every other IT service provider, from Globant to Accenture, is dealing with clients demanding discounts.
Right. That's what the industry calls rate compression. Clients know the economy is shaky, so they ask for like a 10% discount on the hourly rate for developers.
But EPAM managed the opposite.
They did. Peterson explicitly noted that EPAM successfully negotiated actual rate increases with a minority of their clients in Q1.
Wait, how do you pull that off?
Right.
If I'm a chief information officer and my budget is frozen, why am I agreeing to pay EPAM more per hour?
It comes down to the complexity of the work. We aren't talking about basic web design here. We're talking about highly complex, mission-critical engineering.
Like what?
Well, when EPAM is building the back-end architecture that processes billions of dollars in financial transactions, the client cannot risk going to a cheaper, lower-tier vendor.
Oh, I see.
EPAM has pricing power because the switching costs for the client are catastrophic if a cheaper vendor messes up the code.
So they have a moat around their most complex projects. That explains the offensive margin expansion, but I know they're playing defense too. I read the notes on cost optimization. That usually just means layoffs.
They did execute some targeted headcount reductions. They specifically called out reducing staff in Mexico, which was tied to stabilizing a very large legacy client down there.
Okay.
But the more fascinating defensive move is how they are managing what they call their seniority index.
Seniority index. Let me guess. They're quietly swapping out the expensive senior-level engineers who make massive salaries and replacing them with cheaper entry-level juniors to pad the margins.
You hit the nail on the head. And they were surprisingly transparent about it on the call.
Really?
Yeah. In the IT consulting world, your workforce is shaped like a pyramid. You have a few highly paid senior architects at the top and a broad base of cheaper junior developers at the bottom.
Makes sense.
Recently, EPAM's pyramid had become too top-heavy. They had too many expensive seniors on the payroll.
Which absolutely crushes your margins if those seniors are sitting on the bench.
Exactly.
Meaning they're between client projects and not actively billing hours, but they're still collecting their massive salaries.
Exactly. So EPAM is actively rebalancing that pyramid. They're intentionally introducing more junior talent into the mix.
But doesn't that hurt them in the short term?
It does temporarily hurt their overall utilization rate, which dipped to 77% in Q1. Because, junior developers take more time to train and can't be immediately thrown onto complex projects.
Right.
But over the long term, blending a massive base of less expensive junior talent with a few high-level senior architects significantly lowers the overall cost of their workforce.
So they get a raise on the hourly rate from the client, and they lower the average hourly cost of the employee doing the work.
Bingo.
That spreads the margin wide open. That is a brilliant operational pivot.
It really is. But operational efficiency only takes you so far. You still need a product that clients actually want to buy. You need a growth engine.
And that takes us from the spreadsheets to the actual technology. Let's talk about the AI boom.
Let's do it.
Because this is where EPAM's narrative completely separates from the rest of the IT sector. According to this call, EPAM isn't just treating artificial intelligence like a fun side project or, a buzzword to throw into a slide deck.
No, not at all.
They reported that pure AI revenues exceeded $125 million for the first quarter alone.
Let's put some context around that number. That $125 million represents a 20% sequential jump just from the fourth quarter of last year.
That's crazy.
Sequential growth is incredibly hard to sustain, yet this is their fifth consecutive quarter of double-digit sequential growth in that specific category.
A 20% jump in 90 days. And they stated they're tracking confidently toward a $600 million target for pure AI revenue for the full year.
Right.
But what fascinates me is how they're doing it, because they aren't trying to build their own AI from scratch. They announced a massive multi-year strategic partnership with Anthropic.
Anthropic is a crucial detail here. For those listening who might not follow the AI arms race closely, Anthropic is one of the absolute heavyweights in the generative AI space.
Yeah, huge.
They are the creators of the Claude family of large language models, which many developers currently consider to be superior to OpenAI's ChatGPT when it comes to complex coding and logic tasks.
I think we need a metaphor here to understand how this partnership actually works. Because EPAM isn't buying Anthropic, and Anthropic isn't buying EPAM.
Right. Think of it like commercial real estate. Anthropic is producing the raw materials. They are making the absolute best high-tensile steel and concrete in the world.
Okay.
But a Fortune 500 company doesn't know what to do with raw steel. They need a skyscraper. EPAM is the general contractor. They have the architects, the project managers, and the labor force to take Anthropic's raw intelligence and actually build a custom functional skyscraper for the client.
I love that. And to build those skyscrapers, EPAM announced they've assembled an elite cadre of what they call 250 forward-deployed engineering black belts.
Forward-deployed engineering black belts. It sounds incredibly cinematic, but what are they actually doing?
Right, it sounds like a movie. But these are highly specialized engineers who don't just know how to write code. They know how to deeply integrate Anthropic's models into massive, messy corporate databases.
They're the tip of the spear.
Exactly. Behind them, EPM has already run over 20,000 of their regular employees through rigorous AI training.
Wow, 20,000?
Yeah. They're targeting 5,000 official certifications by the end of Q3 and 10,000 by year end. They already have over 1,400 cloud architects fully certified.
They're essentially rewiring a 60,000-person global workforce to be what they call AI native.
Yeah.
But look, talk is cheap. Every single CEO on Wall Street right now is claiming their workforce is AI native. It's the new corporate buzzword.
Yep, you hear it everywhere.
If I'm an investor, I need proof. What are these black belts actually building? Did management give any concrete examples?
They did, and this is where we separate the hype from reality. They provided 3 incredibly specific case studies of this AI integration in the wild. Let's start with a company called Nelnet.
Nelnet. Okay, they're a massive global player in consumer finance, student loan servicing, and education. This is not a nimble Silicon Valley startup.
No, not at all.
This is a traditional, heavily regulated, slow-moving enterprise.
Right. And EPAM's team went in and applied their generative AI tools directly to Nelnet's software development lifecycle.
For anyone not in tech, the software development lifecycle is the entire process of creating software. Planning, writing the code, testing it for bugs, and deploying it.
So what was the result?
They established a 31% increase in overall developer productivity. But more impressively, they accelerated back-end development by nearly 2 times.
Wait, twice as fast? How? I need to understand the mechanism here. How does AI make a human developer write back-end code twice as fast?
It fundamentally changes the developer's job. Without AI, a developer at Nelnet might spend hours writing boilerplate code. The repetitive structural code that connects a database to a user interface.
Oh, the grunt work.
Exactly. With the EPAM integrated Anthropic model, the developer simply writes a prompt describing what they want the backend to do. The AI instantly generates the boilerplate code.
So the human transitions from being a writer of code to an editor of code.
Exactly. The human developer reviews the AI's output, tweaks it for security and compliance, and moves on. The AI also automatically generates the testing scripts to ensure the code won't break when it goes live.
That's wild.
That is how you cut the development time in half.
That's massive for a finance company. Okay, let's look at the second example. A leading global streaming platform.
Oh, this one is interesting.
Yeah, they serve over 10 million concurrent users across 50 countries. If their system crashes during a massive live event or a big movie premiere, it costs them millions of dollars and creates a public relations nightmare.
Right. For this client, EPAM partnered with Amazon Web Services to completely overhaul the underlying infrastructure. They transformed a fragile, single-region platform into a self-healing global system.
Self-healing?
Yeah. The key metric management highlighted was achieving 99.99% uptime with 0 downtime deployments and a 70% reduction in configuration drift, all without manual intervention.
Hold on, we need an ELI 5 and explain it like I'm 5 for some of those terms.
Fair enough.
Let's start with configuration drift. For the non-engineers listening, what does it mean when a system drifts, and how does AI stop it?
Okay, imagine a massive streaming company has thousands of server computers all over the world. Ideally, every single server should be running the exact same version of the software. They should all be configured identically.
Right.
But over time, humans make tiny manual tweaks to individual servers to fix localized problems. Over months and years, the servers drift away from the baseline. They all start running slightly different configurations.
Which sounds like a nightmare when you want to push a global update.
It is. When you try to update the system, half the servers crash because their configurations drifted.
Okay, so what did EPAM do?
What EPAM built is an AI-driven automation system that constantly scans all thousands of servers in real time. If it detects a server drifting from the master configuration, it automatically forces it back into alignment without a human engineer ever having to log in.
So that's the self-healing aspect. What about 0 downtime deployments?
In the old days, If a streaming service wanted to update their app, they had to take the whole system offline at 3 a.m. on a Sunday, push the new code, and pray it worked before users woke up.
Right.
Zero downtime deployment means EPAM built a system where the AI seamlessly shifts user traffic to a backup set of servers, updates the primary servers, tests them, and shifts the traffic back. The user watching a movie never even experiences a buffer screen, let alone a system crash.
That is incredibly valuable plumbing.
Yeah.
Now, let's hit the third example, because this one might be the most impactful for a traditional business's bottom line, a large global insurance company.
Insurance is notorious for being bogged down by legacy systems, massive PDFs, and manual paperwork. EPAM integrated AI into this client's reinsurance claims department, specifically focusing on the first order of loss processing.
Reinsurance is when an insurance company buys insurance for itself to protect against massive catastrophes, right?
Correct. And the contracts, the treaties between these massive companies are incredibly complex. Historically, when a massive loss event happens, human clerks have to manually read hundreds of pages of treaties, extract the billing data, reconcile it against the claims, and type it into a database. It takes weeks.
Just tedious work.
Exactly. EPAM built an AI system that ingests those massive documents, understands the context of the treaties, and automates the billing reconciliation.
And the result?
They decrease the time it takes to process those loss events by 75%.
25% faster. Okay, I hear these 3 case studies. The technology is undeniably brilliant. The value to the client is obvious. But I have to bring us back to the business model of the stock we're analyzing today.
Right.
If you hold EPAM stock, I think there's a massive paradox sitting right in the middle of this room.
Let's hear the bear case.
Historically, the IT services business model is very simple: time and materials.
Yes.
You bill the client by the hour for the humans you provide. So if I'm EPAM and my shiny new Anthropic AI tools make my developers write back-end code for Nelnet twice as fast, doesn't that mean I just billed Nelnet for half as many hours?
Oh, wow.
If I make the insurance company process claims 75% faster, didn't I just destroy my own billable hours? How does a company that survives on billing for human time continue to grow when their core product is an AI that eliminates the need for human time?
That is the single most important existential question facing the entire IT services sector right now.
It has to be.
If your product makes you too efficient, you cannibalize your own revenue. And what was refreshing about this earnings call is that an analyst brought this up directly. They asked CEO Balash Fayash if AI was causing revenue cannibalization. And Balash was brutally honest. He said yes.
Wow. He admitted on an earnings call that their new tech is eating their old revenue.
He did. He acknowledged that clients are actively shifting their IT budgets. They're taking money away from traditional manual digital platform buildouts and diverting it toward these new AI-native products.
Because it's cheaper for them.
Exactly. AI is rapidly automating massive parts of the software development lifecycle, particularly the grunt work of testing and quality assurance.
So if they know it's cannibalizing their legacy business, how do they survive?
They aren't sitting back and letting the old model slowly bleed out. They're proactively engineering a transition. And management introduced 2 crucial concepts on this call that explain exactly how they're rewiring the financial mechanics of their company.
Okay.
The first concept is what they call a dark factory.
A dark factory. I'll be honest, that sounds like a villain's lair. What does that mean in the context of software?
It's a term borrowed from traditional manufacturing. In manufacturing, a dark factory is a facility that's so completely automated by robotics that no human workers are present. Because there are no humans, you don't even need to turn the lights on. The factory runs in the dark.
Okay, so how does EPAM apply a manufacturing concept to coding?
They're going to their clients and offering fully autonomous application maintenance and support. Imagine a massive older software system that a bank uses. Usually, EPAM would build the bank for a team of 20 junior developers sitting in an office, manually checking for bugs, fixing minor errors, and pushing routine updates.
A very low margin, high headcount, tedious project.
Exactly. Now, EPAM deploys an AI agent, a dark factory. The AI constantly monitors the bank's code base. When a bug appears, the AI identifies it, writes the patch, tests the patch, and deploys it live, completely autonomously. No human engineer involved.
So EPAM is proactively sacrificing those billable hours of manual testing.
Yes. They're cannibalizing their own low-margin hours. and replacing them with a highly automated, high-margin AI service.
That is a defensive move.
Right. They know that if they don't automate that maintenance work, a competitor will. So they're capturing that budget first.
Okay, I understand the defense, but it still brings me back to the billing problem. If there are no humans working in the dark factory, how does EPAM actually charge the client? You can't send an invoice for 0 hours.
No, you can't.
And that leads to the second, and arguably much more important, concept from the call. When I read this in the transcript, my perspective on this entire company shifted. Let's talk about tokenomics.
This is the crux of the transition. And just to be clear for you listening, when we say tokenomics, we are not talking about cryptocurrency or blockchain.
Right. This is about how large language models fundamentally operate.
Exactly. When an AI like Anthropic's Claude or OpenAI's ChatGPT processes information, it doesn't read words the way we do. It breaks data down into pieces called tokens.
Okay.
A token is roughly equivalent to a single word or a piece of a complex word. And every single time an AI model reads your prompt or generates a response, the creator of that model, like Anthropic, charges a tiny fraction of a cent per token.
So an API cost.
Yeah.
If I'm just asking an AI to write a haiku, the token cost is practically 0. But if EPAM builds a system for that insurance company that has to ingest and analyze 1 million pages of dense reinsurance treaties every single day, the API costs, the token costs paid to Anthropic or Google, could be astronomical.
Precisely. And this is where EPAM is fundamentally abandoning the time and materials business model. CEO Balazs Fejes explained that for their enterprise clients, tokenomics is becoming the central part of the investment thesis. It's no longer about managing a budget for engineer salaries. It's about managing the massive, highly variable cost of AI computing power.
So how does EPAM make money on that variable cost?
By acting as a high-frequency trading desk for AI compute. The CEO explicitly used the phrase trading desk on the call.
Interesting.
He explained that a company cannot just use one massive, expensive AI model for every single task.
Right. It would be like using a Ferrari to haul gravel.
Exactly.
If an AI just needs to sort a basic Excel spreadsheet, you use a fast, cheap, open source model. But if the AI needs to write complex, secure backend code for a consumer finance platform, you use the highly intelligent, expensive Anthropic model.
Exactly. So EPAM is building the complex infrastructure to automatically route the client's data to the most cost-effective model, millisecond by millisecond. They're managing the blending capabilities. They are handling the multi-sourcing.
So they're the middlemen.
Yes, they manage the vendor contracts, the consumption rates, the real-time price availability, and the caching limits across all these different AI providers on behalf of the client.
That is a fundamental paradigm shift. EPAM is moving from being a staffing agency that provides human coders to being a commodities broker that provides optimized AI computing intelligence.
Yeah, that is exactly what they're doing. As the CEO pointed out, you can achieve real differentiation in pricing and profit levels if you correctly control the sourcing and usage of these models.
They're transitioning to outcome-based pricing.
Yes.
The insurance client doesn't care how many hours an engineer worked. They don't even care how many tokens were routed to Anthropic versus Google. They just care that their claims processing is 75% faster, and they pay EPAM a premium for delivering that business outcome.
And this is why the margin expansion makes sense in the long run. The CEO noted that their current AI native portfolio is already running at a higher profitability than the standard EPAM average.
Oh, wow.
So cannibalizing their legacy business is actually a feature, not a bug, because the new AI business is more profitable once the tokenomics infrastructure is in place.
Okay. If you're a retail investor listening to this, the dashboard is looking incredible.
It really is.
The pure AI growth is explosive. The margins are up, the Anthropic partnership gives them access to top-tier models, and they have a brilliant strategic pivot to master tokenomics and outcome-based pricing. They are fundamentally rewiring the company and winning.
Which brings us to the screeching halt.
Right. Because despite all of that incredible momentum we just spent 20 minutes breaking down, despite beating Q1 expectations and expanding margins, CFO Jason Peterson got on the call and lowered the outlook for the entire year.
He did. They originally had a much higher expectation for 2026, but now full-year revenue growth is expected to be in the range of just 4% to 6.5%.
That's quite a drop.
And when you adjust for foreign exchange, that organic constant currency growth is guided to a very sluggish 2.5% to 5%.
And looking at the immediate future, Q2, they're guiding for revenue between 1.4 and 1.415 billion. That's roughly 4% growth, which is a very noticeable deceleration from the 7.6% growth they just reported for Q1.
It's a significant cool down that clearly spooked the market.
I need to understand this disconnect. If the AI capabilities are so revolutionary and they're saving clients so much money, why is the financial guidance so anemic? What are the actual headwinds here?
If you read the transcript, the phrase management used over and over again was delayed decision-making driven by macro volatility.
Let's translate that, because delayed decision-making sounds like polite corporate speak for nobody's buying our stuff.
It means that enterprise clients are absolutely fascinated by the AI technology EPAM is pitching. They desperately want the 75% efficiency gains in their claims departments.
Right.
But the executives holding the purse strings are terrified of the global economy.
Right. Look at the macroeconomic backdrop of 2026. We are living in a world with stubbornly high interest rates. The cost of capital is incredibly high.
Yeah, it's painful.
If a company needs to borrow money to fund a massive $50 million IP transformation, the interest on that loan is massive right now.
Exactly. Add to that high energy prices and immense global geopolitical uncertainty. The CFO specifically mentioned that the geopolitical situation in the Middle East has gone on longer and had a broader economic impact than their internal models initially projected.
So picture yourself as a chief information officer at a massive consumer goods company. You see EPAM's pitch, you see the Anthropic integration, you want to build the dark factory.
Right.
But when you take that massive contract to your CEO and CFO for sign-off, what happens?
The C-suite says, let's wait. Let's see what the Federal Reserve does with interest rates next month. Let's see what happens with inflation. Let's just hold on to our cash for one more quarter before we commit to a massive overhaul.
The projects aren't necessarily canceled. They're just stuck in corporate purgatory. The ink won't dry on the contracts.
Correct. The demand hasn't disappeared. It's just been pushed to the right on the calendar. And management specifically called out underperformance in North America.
Oh, that's a problem.
It's a massive problem because North America is their largest market, representing 57% of their total revenue. North America only grew 2.5% year over year.
Which makes sense. The U.S. consumer is feeling the pinch of inflation. And management noted particular weakness in the travel and consumer goods sectors.
Right. If you're a global airline or a massive retail chain and you're worried your customers are about to stop spending, the absolute last thing you want to do is sign a discretionary tech overhaul contract. You go into cash preservation mode.
Exactly. And Jason Peterson, the CFO, was very clear that this delayed decision-making behavior really started to crop up in April and May. They saw the pipeline slowing down in real time, which is why they had to adjust the guidance downward for the remainder of the year.
But of course, there is a silver lining hidden in the transcript. And this one is potentially massive if you're looking at the long-term play. Because CEO Balash Vayash claimed that despite this macro hesitation, they have a pipeline of close to 10 unusually large deals waiting in the wings.
We need to pay very close attention to the exact language he used here. He called them AI-enabled vendor consolidation deals.
Okay, let's deduce this. Vendor consolidation, does that mean EPAM is going to these Fortune 500s and saying, look, this new AI technology is too complex for your current fractured IT setup. Fire your 5 other IT vendors, give us their entire budget, and we will use our Anthropic black belts to run the whole thing natively.
That is exactly what it means. In a typical massive enterprise, the IT budget is spread out across dozens of providers. One firm handles the cloud migration, another handles the cybersecurity, a third handles the mobile app UI.
A completely fractured ecosystem.
Yes. What EPAM is pitching is a winner-take-all play. They're using the sheer complexity of integrating large language models as a weapon to steal market share from their competitors. They're telling clients that you cannot build a self-healing streaming platform if 5 different vendors are arguing over the configuration. You need one unified AI-native platform, and EPAM's tokenomics trading desk will run it cheaper and faster than the 5 legacy vendors combined.
That is a viciously aggressive strategy. And the CEO said these deals are, quote, outside of EPAM's norm in terms of size. We're talking about massive, multi-year, non-time and materials contracts.
Huge deals.
But this brings me back to the guidance cut. It's like management is packing for a sunny vacation but putting on a raincoat just in case. If you have 10 mega deals on the hook, why lower the guidance? Why not project a massive Q4?
Because of the exact macro volatility we just discussed, EPAM's management is smartly risk-adjusting their pipeline. Because these vendor consolidation deals are so uncharacteristically large and complex, they require approval from the absolute highest levels of the client's board of directors.
So it takes time.
Yes. EPM knows they're the front runner for these contracts, but they honestly have no idea if the client's CEO is going to sign the paperwork in June or panic about the economy and wait until November.
So they're only promising Wall Street what they absolutely know is locked in and already ramping up. They're treating these 10 massive vendor consolidation deals as potential upside, a bonus, rather than relying on them to hit their baseline targets. It's deeply conservative forecasting.
It is. They're acknowledging the reality of a hesitant market while quietly building the infrastructure for a massive land grab when enterprise budgets finally unlock.
So we've unpacked these stellar Q1 numbers and the surprising margin expansion. We've dove deep into the mechanics of the AI boom, the Anthropic partnership, and the fundamental shift from billing hours to mastering tokenomics.
Yep, covered a lot of ground.
And we've analyzed the frustrating reality of delayed client decision-making that forced the guidance cut. It's time for the bottom line.
Let's lay out the final verdict for the retail investor who is looking at their portfolio and evaluating EPAM today.
I'll start with the bear case. Because if you're a short-term trader, or if you need this stock to perform in the next 3 months, this is a massive headache.
For sure.
The market absolutely despises guidance cuts. Wall Street algorithms sell first and ask questions later when a CFO lowers the full-year outlook. The short-term visibility is incredibly murky.
Very murky.
North America, which is the engine of the global economy and EPAM's biggest market, is showing real signs of corporate fatigue. Clients in travel and consumer goods are dragging their feet on discretionary spending. If inflation stays hot and the Federal Reserve refuses to cut interest rates, those 10 mega deals might sit in purgatory for the rest of 2026. You do not want to get caught fighting the Fed.
That is a very fair assessment of the short-term risks. But if we pull back and look at the bull case for the patient, long-term retail investor, the underlying fundamentals of the business are actually getting significantly healthier.
Margins are the key there.
Exactly. The gross margins are up year over year, which proves they have real pricing power and operational discipline. They aren't just buying revenue by slashing prices, they're executing profitably. Furthermore, the balance sheet is an absolute fortress. They have over $1 billion in cash and cash equivalents sitting in the bank.
And what are they doing with that cash? They aren't just hoarding it. In the first quarter alone, they bought back $264 million of their own stock at an average price of $143.84.
Which is a massive vote of confidence from management.
When a company uses $250 million of its own cash to buy its own stock, they're screaming to the market, "We think our shares are undervalued right now."
Absolutely.
And for context, if you look at their historical valuations and forward multiples, buying in the 140s represents a significant discount compared to where this stock traded during the peak of the tech boom.
Precisely. Since they initiated their share repurchase program, they've returned approximately $1.5 billion in cash to shareholders, and they signaled they will continue to do open market repurchases, which provides a floor for the stock price.
Right.
And if we look beyond the macro hesitation, the fundamental pivot to AI native engineering is demonstrably working. The Anthropic partnership is real, not just a press release. The case studies with Nelnet and the global streaming platform prove they can deliver immense measurable ROI.
If even a handful of those 10 unusually large vendor consolidation deals close in the back half of the year, revenue growth will reaccelerate rapidly. So what is our actionable advice? I'll take a position. This is a classic show me stock right now.
I agree completely. The market is effectively saying, show me that these massive AI deals will actually close before I give you a premium valuation.
For the short-term swing trader, it's a rocky hold. The macro headwinds are too heavy. But for a patient retail investor willing to look past a bumpy couple of quarters, the fundamental pivot this company is making is profound.
It really is.
They're actively tearing down their legacy time and materials business and rebuilding it as an AI-native, outcome-based powerhouse. They're fixing their margins while doing it. Once the macroeconomic clouds part and enterprise IT budgets unlock, EPAM is positioned to capture a massive consolidated share of the market. It represents a very strong underlying foundation for a 3 to 5 year hold.
It's entirely about surviving the current hesitation so they can dominate the future adoption cycle.
And that brings us to the end of our deep dive. I want to remind you, the listener, why we spent all this time breaking down dense, jargon-filled earnings calls. It isn't just about guessing which way a line on a chart will wiggle tomorrow.
No, it's about understanding capital allocation. These earnings calls give you a front row seat to see exactly how the world's largest companies are fundamentally restructuring themselves behind closed doors.
EPAM's call is a perfect microcosm of the entire AI revolution. It proves that while the hype around AI is immediate and explosive on social media, the actual adoption of AI at the enterprise scale is a slow, complex, and heavily scrutinized process.
Very complex.
Transforming a Fortune 500 company isn't as simple as downloading a chatbot. It requires thousands of certified architects, complex tokenomics routing, and massive budget reallocations.
The future is arriving, just not evenly and not all at once.
I want to leave you with a final provocative thought to mull over regarding that tokenomics discussion. We talked about how EPAM's transitioning away from billing for human hours, acting like a trading desk for AI compute, and pricing based on business outcomes.
Yeah.
If they and the rest of the industry successfully master this transition, will the traditional IT services industry as we know it simply cease to exist?
It's a fascinating existential question. The entire concept of an IT services company implies providing human service.
Right. If an AI is the one actually writing the self-healing code in a dark factory, and EPAM is just mathematically routing the API tokens, who really owns the value of the output?
That's the million-dollar question.
Does the value belong to the client who provided the proprietary data? Does it belong to Anthropic, who built the underlying intelligent model? Or does it belong to the integrator, like EPAM, who built the complex plumbing to make it all work together seamlessly?
Right. As AI gets smarter and cheaper, does the integrator become more valuable, or do they eventually get squeezed out entirely by the model creators?
That is the defining question that will dictate the next decade of technology investing.
It really is.
Keep an eye on your portfolio, keep looking for the story behind the spreadsheets, and use the framework we modeled today to find your own insights. Thank you for joining us on this special Talk Tickers edition of The Deep Dive.